Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our good friend Sam Clement. Sam, say hello.
Hey, John, how are you doing?
Sam, I'm doing very well here today. However, when I take a look at the future of interest rates in the United States, because that's just what I do, I don't feel quite as sanguine as I should.
Is that the topic of conversation at parties, too?
Well, actually, I make it a topic of conversation in some places, but as you know, over the last several months, we have had more and more clients ask us, what about the debt situation? What is this going to mean? We can't keep spending money like this forever. And as a result, we've seen yields on the back end of the yield curve kind of tick up quite a bit this year.
It's been, for several reasons. The first one being the debt ceiling, as you mentioned. It's been the topic of conversation, I would say, since then.
Yeah, and for good reason. For a long period of time, U.S. Treasuries were considered sort of the safe haven. Okay, yeah, sometimes they wobbled a little bit. Safe haven, that's where you put your money, your safe portion of your portfolio, because
Sure.
you knew you're always going to get it. And then last year in 2022, if my memory serves, it was the worst year for the overall U.S. Treasury markets since something like 1788.
Yeah, and for a balanced portfolio is the worst since 1931. So these are long time periods and not great dates to be compared to about how accounts worked and performed last year.
And so I make a lot of economic presentations, and yesterday I was making an economic presentation to a group here in town, and I said we just should expect longer term interest rates to remain higher for longer. The 10-year Treasury recently hit 5% for just a fleeting second, rallied back. It's trading around 491 here this morning, and here we are recording on the 25th. But even so, if you take a look at where we were a few years ago, that's a sharp increase. And looking forward, who's exactly going to backstop the long end of the yield curve if the Treasury is draining $900 billion off of its balance sheet every year, and foreigners might not be as desirous of U.S. long-term debt, taking a look at just all of the issuance that we have? And at some point, I guess what I'm trying to say is supply is going to have to trump demand.
Yeah, and that's been really the we mentioned the debt ceiling as the first reason that it was discussed, and then just the supply issuance in the back half. There's talk of the downgrade. I don't really put a lot of weight in that moving the markets, but the amount of issuance, you're right. At the end of the day, almost everything goes down to supply and demand. And when you take out some of the biggest buyers,
take out some of the demand and increase
from the Federal
supply.
Reserve and more supply, and then maybe everyone's kind of pulling back on demand a little bit.
Yeah.
Banks are really the second biggest.
The last thing a lot of banks want is a bunch of interest rate risk right now. So instead of the 10-year, the 2 years is just fine.
Yeah, and especially at a higher rate, even though you're not locked in as long, it kind of makes sense.
So the reason why we're bringing this up, and I know if you're listening to this, any number of podcasts, any number of websites, we're hearing the same thing. Well, interest rates higher for longer. What does it all mean? And the thing that gets me a little bit worried, I'm not going to say I'm staying up at night about that. I generally eat too much and then go straight to sleep, so I'm not worried too much. However, when I think about the lack of willingness to even address runaway entitlements programs in Washington, the sharp increase in our debt service thanks largely to these higher interest rates, and then understanding that what the administration is trying to do to keep the 10-year accumulated debt to just mind-boggling numbers is to largely sit on the Department of Defense. Mm-hmm. If you take a look at the White House's budget estimate for the next 10 years, not a lot of growth in the Department of Defense, not a lot of growth in discretionary expenditures, growth elsewhere. However, Sam, when we take a look at what's going on in the world around us today, the situation in Ukraine, now what's going on in the Middle East, taking a look at Biden recently said we'll defend the Philippines against incursions in South China Sea.
The fishing regions and all that.
And, of course, the situation in Taiwan. And just when you really think about things, how in the world are we going to be able to do all these things that Americans have historically wanted to do, at least since the end of the Second World War, and not increase the Department of Defense? And but if we do increase the Department of Defense, how are we going to pay for it?
That's it's all this is, I guess, not a problem until it is.
Yeah.
Whether that's the Defense Department's budget, and until you get into significant conflict, it's not a problem until it is. The debt ceiling's not a problem until it is. Inflation's not a problem until it is, and
Social Security's not a problem until it is.
All this, and really, I would say at the present moment, outside of some possible black swan events, it's none of these are really problems until they are right now. We're still in that phase of
There's still plenty of money to finance the debt, plenty of it, all that stuff. We don't have any major sort of issues in that regard. It's just there's no end in sight to some of these expenditures.
Yeah, and it's kind of running away. And then you mentioned it, whether it's the South China Sea, whether it's the Middle East right now, whether it's continued investments in Ukraine or what have you. It's hard to imagine that being able to be compressed, that part of the budget being able to be compressed a whole lot.
Well, that's how we're going to try to smooth things over at least a little bit. So let's get back to that question. With the United States increasingly going to have to be on at least a quasi-war footing in order to supply ammunition around the world and training and move aircraft carrier fleets and what have you to various parts of the world. I mean, just moving one of those bad boys costs a lot of money.
Gerald Ford probably uses a good bit of gasoline.
Using a Nimitz class to go somewhere, some hotspot, costs a lot of money. Mm-hmm. And so I don't see the DOD going down, and then all of a sudden I'm sitting there thinking about if the DOD doesn't go down, Department of Defense, the budget deficits get even higher. We have quantitative tightening right now with the Fed shrinking its balance sheet. The Chinese certainly aren't going to finance our ability to thwart them in the South China Sea. Mm-hmm. Where do interest rates end?
I think you could honestly make an argument for them going either way, depending on how smoothly this could happen or how poorly this could happen. But you're right.
Is there anything that we have done over the last 5 years which would give you pause to think that things would go better than expected?
I guess I'm no longer my generation's.
Well, you and I are in the same generation.
Yeah. Well, my former title as most pessimistic person of my generation.
Courtney's no longer here.
Yeah, so I guess I'm an optimist now. There may be an opportunity, but you're right. None of these programs are really going to go down significantly without a significant change, which I'm sure would get pretty much anyone who pushes a change in entitlements, a short exit, quick exit rather.
So they would not be reelected.
No,
I don't
so
believe.
this is very, very unlikely to happen, and then it begs the question. It's hard to imagine, us not putting inflationary pressure on our economy to continue to finance these ever-increasing deficits. And
well, that's the whole deal. I don't see how we do this without some sort of YCC, kind of like what the Japanese do with their yield curve. And in case you really just don't follow the bond market, which most people don't, I get
except the ones you talk to at parties. Yes. I guess they're not following about it. They're just getting followed by.
Sam, I don't go to a lot of parties. I think it's pretty obvious why. YCC is yield curve control, and it's when the central bank buys spots on the yield curve in order to keep interest rates ordinarily lower than they would be otherwise. When the Fed is doing quantitative easing, what they're doing is artificially manipulating the yield curve by gobbling up Treasury issuance. Mm-hmm. When they're doing
which they did for
years.
Close to a decade.
Added close to $8.5 trillion to its balance sheet from 2008 to end of last year. Now what they're doing is they're trying to reduce its balance sheet. That's known as quantitative tightening. And so the Fed is trying to shrink its balance sheet around $900 billion per year for the foreseeable future. However, and that is part of a huge part of the reason why we've seen interest rates go up as much as they have on the back end, because we don't have that buyer of last resort any longer. So if the Treasury is sitting there trying to borrow all this money moving forward, and we've got to buy ammunition for all these people when we were kind of stuck doing so, frankly, I truly do believe the Treasury is going to start yelling at the Federal Reserve in order to stop the quantitative tightening, re-embark on some form of quantitative easing in order to do some YCC, some yield curve control. Talk me off the ledge.
No, it's some resort directionally that way, whether it's actual turning back on the spigot and doing more QE again, or at least stopping the QT, or if that starts to not be the case and the supposed independence of the Fed continues to be supposedly independent, does some does some actual printing of money start to come down the pipe? And I think that could be a possibility. And again, this is not a problem until if interest rates started to get to a point where the auction started to quote unquote fail, meaning there was not enough demand, what have you, or the rate was not satisfactory, then they maybe start turning towards printing money, which actual printing money, not the supposed printing money that people have said has happened.
I'm going to go out here and I'll bet you one of your watery beers that you like so much.
Okay.
Actually, you're better than you used to.
Silver bullet?
No, we'll have to come up with a better bet than that. But along those lines, it's a theme. I will tell you that by the end of the second quarter of next year, 2024, the Fed will very quietly have terminated its quantitative tightening program. What do you think about that?
I think that's fair. I guess I'll take the other side if it's
all right.
If it's a beer.
Fist bump. All right, there you go.
After I get my $1 for the Orioles sweep.
Yeah, I do. Are you that? I'm not going to owe Ryan $5 if Alabama beats LSU this week.
But no, you're right. Something is going to have to happen.
Something is going to have to
go.
give.
That's the easier one because we've already done it. I don't think it'll get to the point where the Fed supposedly stays independent and that doesn't happen, and then we start actually starting to print money and changing bank regulations to offset it and what have you. That's harder to imagine.
That seems almost Orwellian to me, but that's perhaps a conversation for another time. But I will tell you this: I think that's going to happen because somehow they'll equivocate at the Federal Reserve, saying, "Okay, we're not adding to our balance sheet, but if we just keep on reinvesting what we have, that's an additional $900 billion for all intents and purposes that the Treasury didn't have previously."
And maybe they change where they're buying it on the curve, like you mentioned, some kind of yield curve control or something of the sorts.
And so I truly do think that's going to happen. I don't see any other way. But when the Fed does start doing that, it's not a question of if. Trust me on this. It's a question of when. The when, with my bet with Sam, is by the end of the second quarter of next year. By the end of the second quarter of next year, by the end of next year, end of the fourth quarter, it's going to be a fait accompli. I bet you wouldn't even take the other side of that one.
No, I wouldn't take that.
And so that's going to happen, as sure as the nose is on my face. If that's the case, what happens to the U.S. dollar relative to other major trading currencies?
I don't know. What do you think?
I think it goes down in value.
You're right that it's pretty much going to happen, and I think it's an easy-ish bet because we've seen how quickly the Federal Reserve, the Treasury, what have you, as a whole steps into conflicts or crises rather, and it has gotten more and more. And I think it's something that you can't put the toothpaste back into the tube.
No.
And, it started with TARP, which
I tried one time, by the way. You truly can't.
Yeah. So it started with TARP somewhat. That was obviously a great return for the. They didn't lose. The government made a ton of money off of that, and it saved us from complete economic ruin. But that, to me, inarguably changed the risk, parameters around, companies' management, those really large ones, because they knew there was, there's been a buyer last resort. Once you get so big and you're systemically important, it probably changed the risk around that companies were taking a little bit. We saw it, continued support pretty much since then without stopping much. And then we saw it in 2020 again with COVID, and that was both from the Federal Reserve and the Treasury, literally direct depositing money into people's bank accounts. That to me is the newest. You can't put the toothpaste back into the tube.
It's not just the 2020. It's the 2021, and even extending it past that, when there was no need to do it any longer.
Even in 2018, there was a little bit of a crisis around them starting to tighten things a little bit, and they put that on pause.
Yeah, and so when you kind of take a look at things, say you're right. You can't put the toothpaste back in the tube, and we've been doing this. Why is next time going to be different? Take a look at all the money that the Treasury is going to have to borrow. I mean, heck, Sam, we're going to be running, for all intents and purposes, a deficit. The Treasury is going to have to increase its issuance by $2 trillion this year, although the official budget deficit is going to be a little bit less than that.
Yeah.
But issuance is going to be $2 trillion. And this is when the economy is growing at a pretty decent pace.
Especially nominally.
Nominally. So, I mean, so that to me is crazy. If we are exploding our budget deficit when the economy is growing, then my goodness, what's it going to be like next year if the economy grows at a lower rate? Particularly when we have to, keep on buying munitions and probably even step up our game a little bit around the world without the Federal Reserve coming back in and gobbling stuff up. I don't see how interest rates stay contained.
Yeah, and not that we're identical to Japan, but we've kind of seen.
On the flip side, Japan's going to have to quit its YCC.
Yeah.
So
they say.
So they say. So they say. I mean, the yen is now up to about 150 per dollar, the weakest it's been. I mean, I don't know, very long period of time, and that's what the BOJ does, is try to manipulate its yield curve. It always have, with horrible effect, but they just don't seem to learn from their past mistakes. They're going to have to get rid of it in order to get inflation taken care of over there. At the same time, we're going to have to allow, for all intents and purposes, practically speaking, inflation remain higher than we would like by artificially manipulating the yield curve in order to finance our budget deficits.
And we'll continue to have to focus on being a strong export or import economy.
Yes.
That's how we can allow foreign governments to, or essentially have to, help finance our debt.
And that's,
as long as China remains a large exporter to the United States, just mathematical equation, they are going to have to be buyers of U.S.
It sounds crazy. In order to help finance our budget deficit, we're going to have to consume more than we produce. That's bad for Main Street in a lot of ways, I would argue, at least for our production capacity in the United States. And it's all just craziness when you think about the global supply of money. But Sam, I don't see any way that the U.S. dollar doesn't weaken somewhat next year. And that could be a good thing for things like energy stocks or even commodities. Gold's one that comes to mind. And then might need to start thinking about increasing international allocation as well. Now remember, this is a point in the program where I say that any decisions that you make based on anything that you hear at Trading Perspectives, you do so at your own peril, because nothing should be considered or construed as an offer to buy or sell investment securities or products. With that being said, talk me off the ledge here, Sam. I mean, the more I'm looking at it, the more I'm looking at the headlines, the more I'm believing we're going to have to be in this a lot longer than we would have liked.
It's hard to predict which way, a market will go in a couple weeks or a company's earnings will go. So it seems to me the best bet is focusing on things that you have a high confidence in happening, and that's less about a small micro picture and a bigger macro picture.
So what do you have high confidence in?
That the Fed is going to have to do something. That's the higher ups are going to have to do something.
The higher ups are going to have to do something.
Whether it's Janet Yellen and Treasury and the Federal Reserve.
I think it's probably going to start with the Federal Reserve.
I agree. That's the path of least resistance.
Path of least resistance, a low-hanging fruit. Hey, don't shrink your balance sheet. Just don't keep exploding it. That type of stuff. That's an initial $900 billion for the Treasury, for all intents and purposes, that they won't float on the market, and that's where I think that it's going to come from. However, I would tell you this: that's a short-term Band-Aid. Just the cessation of quantitative tightening is not alone going to be able to absorb the amount of deficit spending that Washington is going to have coming down the pike, particularly if we have to significantly increase our defense expenditures.
Yeah.
And so, ladies and gentlemen, you might have heard it here first, but quantitative tightening will be going away by the end of next year. My bet with Sam is a beer by the end of the second quarter. But if we're still talking about quantitative tightening in 2025, or if we have not embarked on some form of quantitative easing, I would be incredibly surprised. In the meantime, the nice little run that we've had with the U.S. dollar, I'm not going to say the dollar is going to collapse, but the dollar should not continue to appreciate relative to other major trading currencies, and that could have a very positive impact on commodities prices, even small cap stocks, or a lot of other things that have been out of favor for quite a while.
Yep.
Talk me again, Sam. Talk me off the ledge.
We're
what is this old dog not seeing here in this new economy?
I think we're on the same page.
We are? Okay, at some point we're going to have to we're going to have to start trading perspectives. But in any event, guys, we always love to hear from you. Also, if you have any comments or questions, please, by all means, let us know. As always, you can drop us a line at tradingperspectives@oakworth.com, or you can leave us a review on the podcast outlet of your choice. As always, if you're interested in reading more, hearing more of what we have to say or how we think, you can go to oakworth.com, OAKWORTH.com. Take a look underneath the Thought Leadership tab and find all kinds of exciting information and links to previous podcasts, links to our blog / newsletter, Common Sense, as well as links to our brand new third quarter of 2023 quarterly magazine, Macro and Market, and all kinds of exciting stories or analysis underneath there. With that, Sam, anything else to say on this exciting topic?
That's all I got.
That's all I've got today, too. Y'all take care.